Good evening, traders, and welcome to this week's Trading Tuesday. First and foremost, just want to make a quick apology about using a slightly unorthodox media to present this week's Trading Tuesday. I know this is not something you're really used to, but apologies on our side. Unfortunately, I'm having to do this on the move, so I'm going to keep this really short and sweet. Now, there is a lot going on in the marketplace right now, as I'm sure you're discovering through your own trades. There is a lot of chatter with with the knowledge of central banks and maybe of going into negative, or well, we've definitely seen it here in Europe, especially with the Swiss National Bank. Japan following suit last weekend. Tomorrow, Yellen testifying. That's what all the chatter's about right now. She's obviously going to have to defend her. Or defend what the Fed's reason and rationale to go through a series of hikes potentially, and that's what was spoken about in December, and definitely we had a 25 basis point hike back in December. Are we going to see more hikes, and how often they're going to come? If it's justified or if it isn't, and how that has an effect on obviously the dollar. A lot that everyone seems as if the dollar was definitely going to increase throughout this year. That was definitely our prognosis here at Phoenix Blue, and that's most certainly what we have seen up till now. But there has been some irrational movements, going to a movement that we have had or have loved to see and watch it happen. We'll just move over to slightly larger time frame so you can see it. It's been the rally of gold. Gold's currently sitting at 1188.09. It's doing really well. Obviously, people are turning to gold as almost as a safe haven, because they know that the equity markets, which is where we should just have a quick look at now, the equity markets. In fact, that is crude. And as we're on the chart, I'm going to talk about it really quickly. It seems as if OPEC have decided that they're not going to restrict supply, and they're going to actually pump more oil out. So we'll probably see a glut of prices as well. This is, as we can see, Brent is down 6.42% on the day. Probably we'll see it definitely get a lot lower, targeting again the 28 mark, and then maybe even lower in increments. Moving away from this, just going to the equity front, and I think if we use this here, we can see a range of indices across Europe. They've definitely taken a hit. We know that oil, and as we've just seen, oil and a lot of the indices, in particular the American indices, they've been trading in tandem. They've been going in directions together. We've definitely seen that over the course of the last few months, and I don't think anything's going to change here. Just having a look at the biggest movers here on the FTSE 100 here in the UK and London on the LSE. We can see the biggest hit are definitely the banks, and the banks are really suffering the effects of negative interest rates. Obviously, them having to hold cash physically from their central banks is causing a bit of a problem for them. You know, them lending out to other firms and companies, and those firms and companies also having, this is a trickle-on effect that everyone's really feeling. They're having problems possibly from the drop in oil prices, the slowdown in China. We know China's definitely slowing down. We're not too sure. Well, I wouldn't say. I think the general consensus is that the data that's coming out from China, the quality of the data and what it's like, how much of a slowdown have we really seen? So that's playing on traders' minds as well. So the banks are definitely feeling it across the board. Just moving over. In fact, if we just move over to the indices in America, and we can see here on this chart we've got three of the primary indices out in America. And we can see that there was a short rally, but they're still trading down for the day. Not doing great, if I'm honest. And I think the consensus generally is the market's really waiting and seeing what Yellen's got to say tomorrow. And I would definitely say for your trades and your up and coming trades that are coming in, definitely hold ground and find and wait for an opportune moment. Give the market some time to go back into a casual pattern rather than erratic movement that's putting people into trades and taking people out. If you are going to take a trade, make sure it's a short-term trade. In fact, what we would tell you to do right now is try and stay away from your computers. Don't trade aggressively. If you're going to trade something, then trade something. I would say intraday over a short period of time. I quite liked the look of the Australian dollar last night. Just having a quick look at that now. If I just go into what I'm talking about. So as we can see, we're looking at a daily time frame here. We can see this huge low test bar that's developed over the course of today. Or a pin bar, however you like to say it. And just going into this, and I'm just going to break this down and take it to a smaller time frame. Just move over to a 5-minute time frame here, and what we should be able to see is over the course of today, we've definitely seen price action really take a sharp drop down before it rallies back up again. And you know, if you're really gonna look to capitalize on any kind of trades, make sure they're short term. You're in and out of the market quite quickly, but be safe. I would tell any amateurs to stay away from the marketplace because you're just going to get your fingers burnt. Until the next time, guys. Happy trading. Bye bye.